In live trading, there is a recurring frustration, mapping a textbook, fresh order block, only to watch price slice through it without a single tick of hesitation. Retail methodologies often describe these blocks as sacred zones where institutions have left massive pending buy orders, effectively guaranteeing a bounce upon return. This chart shows a standard impulse wave and the resulting order block. But as price returns to the level, we see a clean vertical drop. The zone offers no support, and the trade is invalidated in seconds. Quantitative operators identify this frictionless breakdown as a velocity overrun. Price ignores the shallow block entirely, continuing its descent until it reaches a deeper baseline where the actual reversal occurs. The error lies in treating an order block as a static piece of historical data. In reality, a pullback has dynamic mass and momentum that a minor block may not have the capacity to absorb. Understanding why these levels fail requires moving past surface-level price action to examine the mechanics of the institutional order book. Relying on these static zones assumes the market will provide liquidity where it is most obvious, rather than where the institutional program actually begins. The Level 2 order book's depth reveals the failure's physical reason. Passive buy limit orders inside that shallow block are exceptionally thin. Lacking density, they cannot absorb a high-velocity drop. To facilitate a deeper move, algorithms actively pull these bids, causing local support to vanish. This purposefully engineered bidless void is the mitigation gap. Without passive bids to provide friction, price accelerates through the gap, creating the long, fast-printing candles seen during a sharp pullback. This rapid descent characterizes price traveling through a frictionless vacuum, moving efficiently toward the next area of high-density bids. The velocity overrun isn't a loss of market control, it is a programmatic result of bid removal to reach a deeper objective. Why would institutional scripts intentionally clear out bids and ignore these fresh covet levels? To fill an order for 10,000 contracts, an institution must find an equal and opposite pool of 10,000 sell orders. Sellers at a fresh block cannot fill massive institutional buys with extreme slippage. However, a high-density pool of retail stop losses sits just below. The algorithm drives price down to strike this cluster. Once triggered, these stops instantly convert into a flood of active sell market orders. The breakdown of a fresh order block generates the massive sell-side liquidity these algorithms require by forcing early buyers to liquidate. Once this cascade of sell market orders is triggered, the scripts route that liquidity toward a specific objective. Far below the mitigation gap, scripts place their real size. A dense wall of institutional limit orders rests on the 55 EMA Deep B Extreme. Streaming retail sell orders perfectly fill these massive blocks, absorbing the momentum, arresting the fall, and forcing an immediate reversal. The precision of this reversal is the direct result of algorithmic scripts executing their size at predefined macro coordinates. Surviving the mitigation gap requires a shift from watching price levels to verifying transactional intent. To avoid the sweep, an operator must never execute a blind buy at a static price level. We use the volume engine to differentiate between a structural collapse and an engineered sweep. This histogram is bisected by an EMA baseline that tracks institutional participation. When volume prints below this baseline during a move, we call it ghost volume. As price slices through the shallow order block, the volume engine shows transactions printing well below the baseline. Ghost volume is the mathematical proof of the vacuum. It confirms there is no institutional interest at the minor block, and price is simply drifting. Seeing ghost volume is a signal to stand down, allowing the downward momentum to exhaust itself before looking for an entry. The objective is to wait for the moment price strikes the deep standard deviation extreme. When price strikes the 55 EMA, we look for a specific signature, a sharp liquidation wick accompanied by a volume surge, a spike that clears the EMA baseline. This surge provides the structural proof that institutional buy limits have engaged and absorbed the selling pressure. The surge confirms that the liquidity hunt is complete and the accumulation phase has begun. Once the reclaim is verified, the long position is executed with a stop loss hard-coded one tick below the absolute low of the liquidation wick. Welcoming the failure of shallow order blocks allows the operator to wait for the algorithmic breach that generates the liquidity required for a high asymmetry execution.